If you don't like using discounted cash flow to value companies, then what other methodologies do you use? Yeah. So in business schools, what they teach you is to value a company based on the future cash flow a company is going to make, which is logical. It makes sense because the value of a company is the amount of cash it's going to make in the future. And when it comes to discounted cash flow, what you do is you figure out how much money a company is going to make within the next 10, 15 years, whatever it is. And then what you do is between years 11 and infinity, you enter in what's called the terminal value, and then you set up a special interest rate called a weighted average cost of capital. And then you discount that last year, the terminal value, back to today. The problem with DCF is that there's so many unknown variables that over 90% of the value of the company that is based on your financial model is between years 11 and infinity, meaning the terminal value. And that's illogical. It doesn't make sense. There's so many unknown variables, and I hate DCF because of that. Now, the problem with DCF is this. If I told you that x plus 1 equals 3, what is x? Of course, it's 2. If I told you x plus 1 plus p plus w plus microphone plus watch plus q equals 3, what is x? No idea. That's what DCF is. There's too many unknown variables. So what I prefer to DCF, and I still do look at it, but what I prefer is price earnings and price to revenue. Let me kick it off with price to revenue first. So for a lot of companies, they're not profitable, especially the early stage ones. And I've invested in a lot of software companies and private companies when I worked in venture capital. And it was hard to value them based on earnings because they're not profitable. So what you do is you can value them initially based on price to revenue. And so every time you hear of a mathematical formula within accounting and finance, don't memorize what that means, please. Understand it. Otherwise, you'll get a D in accounting like I did, right? And it's a little bit ridiculous. I'm teaching accounting now, but I got a D the first time I took it because I was memorizing accounting and not understanding it. So let's talk about understanding financial ratios. So when it comes to price to revenue, the numerator is price, the denominator is revenue. And from now on, whenever you think of any fraction, I want you to think of the denominator as being the number 1. And here's why. So price divided by revenue, that means for every $1 in revenue, how many times are people willing to pay the price for that company? So if the price to revenue is 20 times, what that means is for every $1 that company makes in revenue, which is the same thing as sales, for every $1 that company makes in revenue, investors are willing to pay 20 times. And it's a little bit elusive and difficult to value companies that way. However, a lot of companies are not profitable. And so I remember back in the summer of 2012, when these wonderful software companies went public that I invested in, including ServiceNow, ticker NOW, and then you also have Splunk, ticker SPLK, as well as Workday, ticker WDAY. Wonderful software companies. And they weren't very profitable when they went public. And so we value them based on price to revenue. And at that point in time, the price to revenue multiple that we slapped on those companies when determining the target price we wanted to set for those companies, the price to revenue was between 15 and 20 times. So for Splunk, ServiceNow, and Workday, for example, for every $1 those companies made in revenue, not profit, revenue, investors were willing to pay 15 to 20 times. And I mention that because when you value companies based on price to revenue, you have to look at what other companies in the sector that are similar are trading at, and you have to look at their growth rate as well. The last thing I'll say valuation-wise is my favorite way to value companies is based on price to earnings, P to E. And similar to the methodology I mentioned before of putting 1 on the denominator, price divided by earnings means for every $1 in earnings on the denominator, how many times that $1 are investors willing to pay? The way to think about price to earnings is to look at the growth rate of earnings as well. And here's how it works. And I'm going to oversimplify things, but this will make a lot of sense, I think. So the S&P 500, which is a collection of 500 stocks that make up the U.S. economy, the S&P 500, historically speaking, has traded around 15 times earnings. And the average company in the S&P 500 has earnings growth historically of, let's just say, 15%. So 15 times earnings and 15%. So there's a ratio called the PEG ratio, which looks at the price to earnings ratio divided by growth. So 15 times earnings divided by 15% roughly is 1. Okay, 1. That's a PEG, price earnings growth ratio of 1. If a company is growing at 30% earnings year over year, it should trade at a price earnings ratio of 30 at a minimum, which means a PEG ratio of 1. That's price earnings 30 divided by 30% growth rate. So that's how to think about it. And if a company is only growing earnings at 8% per year, then it should trade at a PE of 8 times at a minimum, right? So that's PEG, price earnings divided by growth. 8 divided by 8% growth is 1. So if you see a company trading at a price to earnings ratio, or a PEG ratio, I should say, of 2 times, that means it's trading at twice its growth rate, and that's too expensive. And a lot of hedge funds look to short those stocks as long as they're not crowded. That's what I used to do in my previous life when I worked in the hedge fund industry. And so companies that are too expensive relative to their growth rate are not great investments in the long run. So if a company is trading at 20 times earnings and the growth is only 10%, then 20 over 10 is a PEG of 2. Too expensive. Too expensive. Last thing I'll say in this, in terms of valuing companies, you ever notice how a company reports earnings and they miss by like 30% and the stock gaps down 30%? It's because people value the company based on price to earnings. And if earnings are 30% lower than expected, then the stock should reflect that immediately in many cases. Now, if you have additional questions about that, please let me know. But the bottom line is, when you're valuing companies, you never want to just look at one methodology. You want to look at 2 or 3. So that when you value companies based on 2 or 3 methodologies, if you take the average target price of all 3 methodologies, then it minimizes your margin of error, because predicting the future is tough when it comes to coming up with target prices.